With this trade on the S&P 500, I was able to 4x my initial risk, a 4R if you will. On this gold trade, I made a massive return by catching a huge move to the upside as price broke to new highs. And on this Forex trade, the dollar Swiss franc, I was able to capture a massive move lower as the market completely tanked for the dollar. And since 2020, I've been able to make $387,000 on my main public portfolio. And in this video, I'm going to be letting you in on a little bit of a secret on how I catch these monster trades periodically in my trading. Specifically, we'll be talking about my 3-part process on how I spot opportunities in the markets and find occasionally these monster winners in the markets. Now, a bit of a disclaimer as we get started, trading is difficult and I don't have trades like these every single day. But in this video, I'm going to be going through and mapping out the approach that I use to find these trades every once in a while and how they can be incredibly lucrative when taken advantage of. And before we dive into the strategy, let me tell you about today's video sponsor, Vantage. Vantage Markets allows traders outside the United States to trade pretty much everything in a singular brokerage. Now, especially in these crazy times, CFDs or contracts for differences allow traders outside the United States to take advantage of market volatility and find possible trade setups on a brokerage that allows them to trade pretty much everything in one singular portal. With Vantage, you can trade gold through XAU USD, you can trade stocks through stock CFDs they offer, indices, and so much more all in one broker. They have low trading fees and they also offer a special sign up referral bonus to my subscribers. All of that information can be found out down below in the description, and make sure to use that link specifically to take advantage of the welcome bonus they're offering. So when it comes to my approach in the markets, there's basically 3 components that we're going to isolate in this video. We're going to talk about technical analysis, sentiment analysis, and fundamental analysis. And these are the 3 pillars or the 3 parts to what goes into finding great trades for me personally. And before we talk more about this, let me just map out that this is my approach to the markets. I'm not expecting this to be your exact way of approaching it, but I do hope that this video will help you to think through the ways you're thinking about the market and maybe take bits and pieces that you like or test certain ideas that I discuss in this video. So the technical analysis component is pretty straightforward. I use technical analysis, which is charting, drawing in support and resistance, indicators, all that stuff. On the technical analysis side of things, I use this to help spot entry and exit timing within my trading. I also use technical analysis to help manage my risk through stop loss placement. Next up is going to be sentiment analysis, which we'll dive into further here in a moment, which helps me to spot strong risk to reward setups. And this is really key to finding great trades. You want to be looking for opportunities where the risk is much smaller than the potential reward. And finally, we'll talk about fundamental analysis, which is ultimately what helps me determine the direction that I want to be trading, long or short, on a particular market. First up, we'll be taking a look at technical analysis, which is what I use to look for entry and exit timing. So when it comes to timeframes, the first and foremost thing is I personally am a swing trader, but the ideas that I'm discussing could probably be used on other timeframes. But specifically, I like to use the daily chart and the 4-hour chart predominantly. These are my 2 favorite timeframes to trade. Next up, we'll talk about my entry style. And when it comes to this, I keep things as simple as I possibly can. In fact, you could go to the library and look for trading books about technical analysis, and there's a good chance that my approach, my way of entering the market, is going to look a lot like those textbook retail trading strategies. I keep things really simple because I don't believe when it comes to technical analysis that I need to get very complicated. So I'm looking for support and resistance. I'm looking for market structure, which is key levels like structure of higher lows, higher highs. And specifically, I like to enter with a break and retest approach. And a quick note on this, many times people obsess over entries, but in my opinion, the most important thing when it comes to technical analysis is actually exiting trades, both from a managing risk perspective and maximizing winners. The money is actually made on the exit. At the end of the day, profits or losses are realized on the exit of the trade, not the entry. And for my core trading strategy, the exit style that I opt in for is trailing stops. And a little bit of a note here, I do also tend to choose markets that have relative strength. So let's say that we're looking at silver and we're looking at gold. And let's say that silver is trending to the upside, but that gold is really ripping to the upside. Some traders actually prefer to go for the lagging instrument and trade thinking that this could have a catch-up trade. But if I want to be bullish on metals, typically I am actually going to favor the strongest of the pack and look to trade that one in the direction of the predominant momentum, in this case to the upside. Now, like I said, there's not a right or wrong approach to this. Some traders do very well trading the one that is lagging behind, looking for the catch-up trade, if you will. But on a relative strength basis, in terms of markets, I typically go for a leading asset, something that's moving very strong with a lot of momentum. So to map out visually what I'm looking for in terms of an entry, let's assume that we're looking at a chart in which case I have a bullish overall bias and the market is trending to the upside. Now remember, I mentioned that I'm looking for market structure, and I'm looking for support and resistance, and I'm looking for a break and retest. So in this case, when it comes to market structure, we would identify that there are higher lows in this market as well as higher highs. This would tell me that the structure of this market is continuing to the upside overall. The next thing I would do in this situation is spot key levels of resistance in this upward chart and look for those levels to actually break. So let's say this chart breaks to the upside and starts to advance higher. What I would now do is actually mark that broken level of resistance as a potential level of support, and I would look for a long entry on a retest of this area. And as this market retraces, I personally don't usually look for confirmation or a candlestick pattern or anything fancy like that. I just enter on a break and retest. Given that I have a bullish perspective on the market in question, I'll usually take my entry on that retest, looking for this pattern to continue. Stop loss placement is really important for me. So let's just say that we took this trade. I basically would like to see this area where we were consolidating and breaking out of. I don't really want to see price to go much lower than that. So I would usually put my stop loss relatively below this area. Now you might say, Nick, this is pretty basic stuff. This has probably been watched by like every trader on planet Earth by now. And the answer for me on that is actually yes. I use a really simple technical entry style, and I actually prefer it that way. As we get into the remaining components of this video, you'll notice that I spend a lot more of my focus on fundamental and sentiment analysis when it comes to really finding those great trades, and we'll discuss those up next. To conclude the technical component of this video, basically the next part is I trail stops. So anytime from here that we put in some sort of higher low in this uptrend, my strategy from here will be to take that initial stop loss and to move it into profit further and further behind these higher lows until ultimately this trend reverses, breaks structure, and I take a profit. Now, there are some obvious pros and cons with this. If the market keeps going like this forever, and for a very long time, I'm able to continue trailing stops, I can have massive, massive home run winners. That's the ideal part. The downside is that a lot of times the market whipsaws and takes me out of trades preemptively, which in my view is a cost to doing business when it comes to trading with this style. I inevitably am going to get whipsawed out of some trades. Some trades are just not going to work out great, but it's worth the ultimate price of potentially capturing those massive winners with my style in combination, not just with technicals, but the other components we're about to discuss. Next up, we're going to talk about sentiment analysis. And if you recall, what I talked about with this is sentiment analysis is a fantastic tool to look for optimal risk to reward setups. So let's say we're looking at a market and the chart looks like this, and everybody is very, very scared and bearish on this chart. If the crowd sentiment thinks that this thing is going to continue to go crashing lower at a very high rate, the risk to reward factor that I'm talking about is that if there is something that changes this dynamic, suddenly many people will be rushing for the exit, producing what I believe to be a very strong reward relative to the risk taken on this trade. So anytime you take a trade, there's risk, right? But when you can spot opportunities where everybody's on one side of the boat and then look for that catalyst that changes things the other direction, there's some really good risk to reward and some very nice profits that can be had by people who spot these opportunities. So what indicators do I use to spot when people are very, very heavily loaded on one side, long or short, on a particular asset? Some of my favorites include the put to call ratio, the AAII Investor Sentiment Survey, and Retail Sentiment. The put to call ratio is one of my favorite tools for this. You can see I've selected the S&P 500, and the tool that I'm using is my company's software, the Edge Finder. Now, the way to read the put to call ratio is to basically wait for the extreme levels to get met, whether it be a high demand for puts in the option market or a high demand for calls in the options market. The put to call ratio simply reflects the demand, the volume of puts versus the volume volume of calls being traded on the options market, specifically for the S&P 500 in this case. So when the crowd is really scared, we tend to see the options volume for puts go parabolic. This produces a contrarian bullish signal, and when we see the opposite extreme happen, we call that a contrarian bullish signal. I've done a full video on the put to call ratio, which will link in the description and in the top right of the screen right now if you'd like to explore that topic further. Another tool that I like to look at for specifically stock indices is the AAII Investor Sentiment Survey, which is a weekly filed survey showing crowd sentiment on the S&P 500 going forward. When this chart reaches extreme levels like it has been in recent times, that would suggest a contrarian potential bullish signal would give you a huge rip to the upside, simply because if you see everybody parked on one side, in this case, 59.3% of people saying that they're bearish, that's a very high rate of people concerned about the market. If you get some good news, the risk to reward could become very attractive on the long side, and in my view would be less attractive on the short side. Finally, we can take a look at the retail sentiment tool, which shows us the overall positioning according to some CFD brokerages in the Forex space on key charts that we may be watching to look for extremes in terms of positioning one way or the other. If you'd like to explore a full list of tools, including all of our sentiment tools, economic tools, and more, check out a1trading.com. or explore the links in the description below. Next up, we'll talk about fundamental analysis, and this is a lengthy topic that I'm going to give a high-level viewpoint of, and also leave some links in the description if you'd like to explore these topics in their entirety. So I'm going to focus on four main kind of areas when it comes to trying to get a perspective of the economy. And this, remember, is the direction, and this is a very direction, right? This is a very important component to what I do, because the fundamentals are ultimately trying to figure out which way the wind is blowing. It's probably, in my trading, the most important core component of the three things that we've just discussed here. So in this case, we're going to be looking at, or what I look at, is economic growth data, things like the GDP statistics, purchasing managers indexes, and retail sales numbers. This gives me an idea of growth of the economy. Next, we'll talk about inflation data, which is prices in an economy, which can be very, very vital to the state of the consumer, the growth of the economy, etc. For this, I'm going to be looking at key metrics like the consumer price index, the producer price index, and the personal consumption expenditure. And by the way, one of the key reasons fundamental analysis is so important is because it's what the Fed uses to determine whether or not they're going to raise or lower interest rates. And so watching this data and trying to make an educated guess as to where the Fed might make their next move is a very vital component to spotting the correct direction that the market's likely to head in next. Labor statistics are also something really important. This is going to include unemployment rate, employment change, or NFP, and then wage growth. And because economic data can be a bit of a daunting task to try and keep up with, we've built software within our company to, of course, track all of this data each and every day to help us spot opportunities on the macroeconomic trends side of things. For example, we're looking at our US economic heat map, which shows us all sorts of stats, the PMIs, GDP, CPIs, all that stuff, and how it's potentially going to impact key charts like the US dollar or the US stock market. Now, how do I pull all of this together? Clearly, you can see I've invested a lot of time and a lot of effort into building the system and strategy that I use. We've built software around it. I've really defined personally how I approach the market, and it's really paid dividends for me personally, but it's been a tremendous amount of work. So I'm telling you that whether you trade similar to me, or you took some things from this video and you're like, oh, I like these things, or you completely trade differently and disagree with a lot of the things I said, totally cool. But I would encourage you to ask yourself a couple things like this. How do I systematize what I'm doing, right? Because again, at the end of the day, I just threw out a whole bunch of things that I'm considering to find the trades that I take. But how do I systematize it? And for me personally, this involves using an algorithm to essentially go through all of the market data we've just discussed and essentially look at sentiment, economic data, and technical data to punch out a bias for different charts so that I can systematize what I'm doing. The next question is, how do I make this repeatable, right? How do I regularly look for new setups? And for some traders, this might be setting up alert systems or ways to get notifications when certain criteria for you are met. And then finally, how do I ensure my trading rules are actually met? How do you know you're going to stick to your system? And for me, with having such a simple kind of table that I just showed you, that bias table, that top setups, I know very well if I kind of quote unquote have permission from my own system, if I should be looking for a possible trade. So I'm marrying up all the things that we just got done discussing, right? I'm looking for technical entries and exits based on my own analysis. And then I'm also using the fundamental analysis tools that I just showed you and the sentiment analysis tools as well to try and spot those good risk to reward opportunities. I'm pulling it all together, and there is a learning curve. It takes practice, and none of this is easy, right? Trading is very difficult, but this is how I'm doing it, how I'm bringing it all together to find those occasional really great winners that I catch. So let's have a quick reality check, because I showed you some really great trades, but the reality is I also have a lot of losing trades, and trading is not easy. While I've been able to produce profits over the years, it doesn't mean I haven't had drawdowns, losing streaks, periods that are frustrating. It's part of the game. And in order to hit those home run trades that I showed you at the start of the video, you've got to swing, right? You're gonna have to miss the ball, right? You're gonna have to strike out a couple times. We're making a baseball reference here, but choose your reference. The point is, you're gonna fall down. It's not gonna be easy no matter what style of trading you do. Every system, every strategy has pros and has cons. The reality is not every trade is gonna hit. You can do all of the things that I just discussed perfectly according to whatever your system is, or even if you're just using the same kind of approach as I am, you can do everything right and still have a losing trade because some tweet or some event happened that changed the trajectory of your trade. Unfortunately, the markets are just not certainly predictable, right? There's uncertainty in all of this, and so that's why most trades, while they may not be super impressive, I have to keep swinging, keep moving forward in order to find that great potential runner every once in a while. With this approach that I'm discussing, the reality is my win percentage is actually quite low. I have a lot of small winners, a lot of small losses, and then every once in a while I catch a really big runner. So a couple key takeaways from this is that the quality over quantity rule here is very applicable. I look for high quality trading setups. I'm not looking to throw a bunch of stuff on the wall. I'm really trying to look for quality setups and have patience to actually wait for them to come to me. Another thing that I've learned the hard way over the years is that small position sizes keep you in the game when you go through drawdowns, which are inevitable regardless of what strategy you choose. And I cannot overstate, by the way, how important small positions actually are to keeping you in the game over the long term. Another common pitfall for traders is giving up too early whenever they go through a drawdown. It's important to stick to the system, and abandoning ship is not an option if you actually have done this last one, which is to backtest extensively. If you've really backtested, really invested time into building out your system or strategy like I have, it's going to be very, very unlikely for you to bail on your system unless you're making a bunch of position sizing mistakes. Most likely you're going to stick to your system and you're going to work with it rather than abandon it every other week like most new traders. They just switch new strategies every single week. I hope this video was helpful to you in identifying some things that you may want to try in your own strategy approach and sharing with you the approach that I use, which I've basically continuously, and I hope I was also able to illustrate to you a general overview of what I look for to find the trade setups that I take. Remember that if you're looking for a better brokerage and you're outside the United States, consider checking out Vantage for that welcome bonus down below in the description. Thanks for watching.